And now let's talk about the calculator purification ritual. Get your calculator out. Here we go. Sometime at some point, your calculator is going to start spewing nonsense. And here's how you fix it. Are you ready? Okay, first thing I want you to do is hit the yellow button, 2ND, second. Then I want you to look down above the plus minus key. What does it say? Reset. So we're going to hit that. And here it says RST, and that's supposed to be a question mark. And it's telling us what we want to do. If we want to reset, we want to hit the enter key. So I'm going to hit that enter key. And now it says rust 0.00. That's the first step. The second step, oh, for shame, she's late. The second step is to say second, and then the decimal point. What do you think we're going to set here?
9.
Yeah, the number of decimals, and we're going to use the 9 because 9 is a very special one. And once I do that, notice that it doesn't show any decimal points. 9 only shows the decimal points that are actually in existence up to 9. So for instance, if I say 1 divided by 2, it's just going to say 0.5. It's not going to say 0.50. If I say 1 divided by 4, it's going to show 2 decimal places. If I say 1 divided by 8, it's going to show 3, and so forth. Now, what if I say 7 divided by 22? It's going to show me 8 decimal points. Does that mean that, or 9? Does that mean that's all that there are there? No. It goes on and on and on, but this is all the calculator can display. So if your calculator starts talking smack to you during the exam, that's what you do. Do you think it might be helpful to actually have those on the corner of your note sheet? So it was second, plus minus, enter, second, plus minus, enter, and then it was second, decimal point, 9, enter, second, decimal point, 9, enter. And if you do that, then you should be in good shape. If your calculator's still throwing garbage answers after that, try putting in a new battery. If that doesn't work, spend $30 and get a new calculator, because it's not worth getting a bad grade in this class because your calculator is on crack. Questions? First one we're going to work is number 3. Now let's talk about how to approach a problem in finance. The first thing you want to do is go to the very bottom and find out what they're asking for. These people are asking for net working capital. And so now we can go through and read. And as we read, we're going to be looking for the things that are necessary to calculate net working capital. By the way, what's the formula for net working capital? Yep. Net working capital equals current assets minus current liabilities. And it looks like they're listing a bunch of things here that can either be current assets or current liabilities. So as we go through, and feel free to put this on your scratch paper and mark things down like this. So we're going to categorize all of these things as either current assets or current liabilities, and then we're going to do the math. So the first thing we're looking at is cash and marketable securities. What is that? Current asset or current liability? Current asset. And it's what, 300,000? The next thing is accounts receivable. What's that? Current asset or current liability? Current asset. And then we've got inventory. What's inventory? Current asset or current liability? Yeah. Accrued wages and taxes. Yeah, liability. So anything that you hear that has accrued typically is going to be a liability, accrued taxes, accrued expenses, things like that. Now, if you see the word payable at the end, that's also a very good sign that it is a current liability. So we've got accrued wages and taxes over here of $50,000. By the way, do you guys know how accruals happen? So let's say the end of the year splits a pay period in the middle. We owe these people for what we've already used them for at the end of the year, but we haven't paid them yet. And so we would have accrued wages and taxes. It's kind of like a payable to our employees. Accounts payable, where does that go? Yeah, liabilities. And notes payable.
Neither.
He says neither. Why are you saying neither?
It's a long term.
Ah, but what's a note? It's 0 to 1 years, so it's short term. So we're going to put that in here, 500,000. So over here we have 600,000. And then over here we have what, minus 950,000. And that gives me minus 350,000. Now, is that the correct answer?
Yes.
And it's the one that, so let's, I guess I have to submit the whole damn thing to find out, right? But minus 350,000 is the correct answer. Okay, you made me doubt myself, but I was wrong to doubt myself. Okay, so minus 350,000. By the way, is that good? Oh no, this company's on the highway to hell. We've got to figure out some way to boost our current assets without increasing our current liabilities, or we're going to be out of business in short order. Okay, so that's number 3. Next one, number 4. Okay, what's the first thing we do when we see a new problem? Look at the last line. What was the end of year balance for accounts receivable? Oh, this one's hairy. Okay, so here we go. Barney's Franks has net cash flows from operating activities for the last year of $21 million. The income statement shows that net income is $25 million. Depreciation expense is $7 million. During the year, the change in inventory on the balance sheet was an increase of $6 million. Change in accrued wages and taxes was an increase of $2 million. And change in accounts payable was an increase of $2 million. At the end of the year, the balance of accounts receivable was $7 million. What was the end of year balance for accounts receivable? Oh my goodness. So let's talk in big terms about what we've got here. Hopefully you guys remember the accounting statement of cash flows. And it's broken down into 3 categories. At the top we have the operating. And what's the next one? Capital, so the investments, right? And then what's the last one? Financing, very good. I'm sorry, I'm having a little nose problem today. Okay, back to the story. So this stuff that we're looking at here all has to do with the operating portion. Now, the way we do an accounting statement of cash flows is called the indirect method. And what we do is we start with the net income, and then we make adjustments to get us back to where we are with real money. And the reason net income isn't real money is because it's got deferred, so non-cash expenses like depreciation, things like that, and deferred taxes. And it also treats any sales that we've made like we received cash, but in fact we might have received an accounts receivable. It treats any purchase that we made as if we were paying cash, but we might have paid with accounts payable. And so all those things are going to jack with your cash amounts. So what we're having to do here is we start with a messy number, and then we have to make some adjustments to get back to what is actually cash. Okay, now, what is the top line on the accounting statement of cash flows? Well, we start with net income. How much do they say net income is here? 25 million. Very good. By the way, did you notice that we didn't start with the first number they threw out? We did not start with the first number they threw out. In fact, that's where we're headed down here. That's going to be, the end is going to be that 21. Okay, now, the income's, let's see, 25 million, and depreciation of expense is 7 million. What do I do with that? Yeah, I've got to add it back because depreciation is a non-cash expense. Okay, now it gets hairy. During the year, the change in inventory on the balance sheet was an increase of $6 million. Now, inventory is an asset. And anytime you increase an asset other than cash, here's what happens. The asset goes up, cash goes down. It costs cash to put that inventory on the shelf is the way to think about this. And so if our inventory actually goes up by 6 million, what does that mean happened to our cash? Yeah, it's going to be minus 6. The cash is going down by 6. So this is all in terms of cash is what we're trying to get to here. Okay, let's see. Accrued wages and taxes. What did we say if is it an asset or a liability if it says accrued wages and taxes? Liability. Now, here's the fun thing about liabilities. Liabilities and cash go in the same direction. I'll demonstrate for you. If you borrow $10 from a friend, what happens to the amount of cash in your pocket? Goes up by 10. But what happens also to your debt? Yeah, and so liabilities always move in the same direction as cash. Assets always move in the opposite direction. So since we're looking at a liability here, it says it was an increase of 2 million. Liability goes up by 2. What happens to the cash? Yeah, it increases by 2. Okay, now let's see what else we've got here. Accounts payable, is that liability or asset? It's a liability. Accounts payable is a liability. So if it goes up by 2, what happens to cash? Yeah, it goes up by 2. Okay. And by the way, I should be putting change on these so you'll realize that these are change values. Okay, now they tell us the beginning of the year balance of accounts receivable was 7 million. What was the end of the year balance for accounts receivable? So what we're going to solve for first is the change in accounts receivable. And so that's where really all that's left here. Change in accounts receivable. And if accounts receivable goes up, what does that mean happens with cash? Down, because accounts receivable is an asset, and we know that assets and cash move in opposite directions. So here's what we're going to do. We're going to call this minus X, and X is going to represent our change in accounts receivable. And when I add all that stuff up, I get net cash flows from operating activities. Do we have that number? Yeah, it was the very first one that they gave us. Okay, do we have enough information now to find the change in accounts receivable? Yeah, so we're going to take 25 plus 7 is 32, minus 6 is 26, plus 2 is 28, plus 2 is 30. 30 minus X is 21. So what would X be? 9. Now, if we were given the beginning of the year balance in accounts receivable with 7 million, and we're going to add this change in accounts receivable to it, so plus 9, what do we get? 16. Is that the correct answer?
Yes.
Whew! 2 for 2. By the way, this is some of the toughest stuff for students to remember. how to handle these changes in your current assets and current liabilities. And it all boils down to assets and cash move in opposite directions, liabilities and cash move together. Okay, number 6. First thing we're going to do is look at what are they asking for? What are they asking for here? Depreciation expense. And then they give us some information, and it's looking a whole lot like an income statement. They start with net income, or net sales, sorry. Sure. We're not doing an indirect statement of cash flows here. Sales. Sales are 3.6 million. Then they tell us cost of goods sold. That's 2.3 million. And then they give us a couple of pieces of information, and at first you're saying, what's that about? What do we know about addition to retained earnings and dividends? If we add those two numbers together, what do we get?
Net income.
Yeah, we get the net income. That's going to come in handy here in a bit, but we're not quite there yet. They also give us an interest expense of $100,000. And then there's one thing left before I can calculate my pre-tax income. What would that be? What else do I need to subtract?
Depreciation.
Yeah, depreciation. And we're just going to call that X because we don't know what depreciation is. And then this is going to give us our pre-tax income. Pre-tax income. We do not know what that is yet, but we do know that if we subtract out our taxes, the thing that we wind up here on bottom is called what? It's the net income, right? And how did we calculate the net income? What do we say? Two things you add together. What are they? Addition to retained earnings and the dividends, right? And so it's just 100,000 plus 200,000 tells me that this net income is 300,000. Does that sound right? Okay, now the other thing they tell us is that the tax rate is 40%. And so if I take, if I say my net income is equal to the pre-tax income times 1 minus the tax rate. So I'm getting to keep everything other than the taxes. So does this make sense to you guys? If I multiply by 1 minus the tax rate? I could write this out as the pre-tax income minus the tax rate times the pre-tax income. This is just when I pull this out, that's the distributive property, right? Okay, now I have net income. I have T. What I want to do is rearrange this thing to get pre-tax income. What do I do?
Change the places.
Yeah, I changed the places. How about divide both sides by 1 minus T? Divide both sides by 1 minus T. If I divide both sides by 1 minus T, it brings this over here. It leaves pre-tax income by itself. Okay, so now we know that what we're really looking at here is 300,000 divide by 1 minus 0.4. Can you guys do that bottom math in your head? What is 1 minus 0.4?
0.6.
Yeah, 0.6. So we're going to take 300,000, divide by 0.6. And that's going to give us $500,000. So this number right here is 500,000. And so now we can go back and we can do some collecting on both sides. We'll start here. 3.6 million minus 2.3 million gives us 1.3 million. Does that sound right? And then if I subtract another 100,000, I'm down to 1.2 million. So 1.2 million, what we're really looking at here is 1.2 million minus x equals 500,000. You see how that works? So I'm just collecting these together. That's 1.2 million because we subtract. And then I am setting that equal to the pre-tax income of 500,000. When I do that, what is x? 700,000. Now, if you can't do that math in your head, just take 1.2 million in your calculator, subtract 500,000, and that's going to give you 700,000. And when you move x across the line, it loses that negative, so x is equal to 700,000. Is 700,000 the correct answer? Hot damn. Okay, 3 for 3. I can tell some of you, just by the look in your eye, some of you are rusty on algebra. Practice, practice, practice. And if you're working with the practice problems and you can't understand things because of algebra, I've included a handy-dandy algebra review, like the Cliff's Notes of algebra. It's on Brightspace. Okay, now let's erase this and move on. Now we're on to number 9. Okay, look at this down at the bottom first thing. What is AJ's ROA? It says you've been asked to calculate their ROA. They give you the following information. Sales of 50 million, total debt of 20 million, debt ratio of 40%, and ROE is 15%. Using this information, what is AJ's ROA? Well, we've been given ROE, and we've been given enough information to find the equity multiplier. And we know that ROE is equal to ROA times the equity multiplier. Are you with me so far? Okay, let's see what else they give us here. So we could go ahead and calculate the equity multiplier. So they're telling us that they've got total debt of 20 million and a total debt ratio of 40%. So what they're saying is TD over TA is equal to 0.4. Does that make sense? Okay, now we need to be able to figure out the total assets in order to be able to figure out this equity multiplier thing. So I'm going to solve this thing by dividing both sides. I'm going to divide both sides by 0.4 and both sides by total assets. And when I do, that pops total assets up on the top. By the way, I flopped these. That puts total assets on the top, and then it puts 0.4 below here. How much do they say the total debt is? 20 million? What is 20 divided by 0.4? Is it 50? Okay, now we know that total assets equals total debt plus total equity. Therefore, total equity is equal to total assets minus total debt. Does that make sense? Yeah. Okay, so we've got 50 minus 20 means our total equity is 30. Does that make sense? Okay, now all we have to do to get our equity multiplier, we know it is total assets over total equity. And therefore it is, in this case, 50 divided by 30. Okay, now I'm actually going to be saying, I'm looking for ROA, is that correct? Yeah, so what I want to do is I want to divide both sides by equity multiplier, and I get this right here. And that's the same as, let's see, what do we got for ROE? 15% divide by the equity multiplier of 50 over 30. So let's see what we can do with that. I'm going to take 15 divide by open parentheses 50 divide by 30 close parentheses equals. I'm getting 9%. Now, how can we check our work? What if I take 9 times 5 over 3? 9 times 5 is 45, divided by 3 is 15, brings us back to that ROE we had at the beginning. Another thing that I did not know when I first saw ROA what they were going to get us to do. It could have been, they could have given us total asset turnover and profit margin, because if you multiply those two things together, you also get ROA. Now, why you read the question first, so you'll know what kinds of ingredients to be looking for. Questions? Okay, now we're on to number 12. They're asking us, what is the sustainable growth rate? So, sustainable growth rate, my formula is RO, is it E or A? E. Times B divided by 1 minus ROE times B. What's B? Plowback ratio. Now let's read this question. It says last year they had an ROE of 12.5% and a dividend payout ratio of 30%. What's B? 0.7. How did you get there? Yeah, 1 minus 0.3. What do most students do? They just use the 0.3. The only way you would still get it right is if that payout rate was 50%, because then the retention ratio would be the same.
So I understand that equation, but why would you not use the other equation if you're given ROE and the DBR? Like, how do we know to use that one rather than the...
So what's the other equation?
ROE times 1 minus DBR divided by 1 minus ROE times 1 minus DBR.
I'm going to come look at your formula here.
ROE times 1 minus DPR divided by 1.
Where did you get that?
1 minus DPR. Well, that's what I was doing on the homework whenever I was solving that.
Did it work for you?
Yeah, but it won't work on this problem.
Well, then maybe don't use it.
Yeah, I didn't know.
I don't know where you pulled that out of. And sometimes you can get lucky and get to the right destination using the wrong map. Phew, I'm glad you mentioned that, because, okay, yeah, this is, if you go back and look at the slides, this is the only formula that I gave you for sustainable growth rate. Okay. So we know Question?
I spaced. B is 30% in this.
No.
Dividend payout? No.
Dividend payout ratio is 0.3. And we know that,
Minus 0.3.
so it's 1 minus 0.3. Yeah, and so it's going to be 0.7. Okay, so here we go. By the way, we're putting this stuff into a formula. Do we use the whole numbers or do we use decimals? Yeah, decimals. Anytime we're putting it into an equation, we use decimals. They say that the ROE is 12.5%, is that right? And then we're going to multiply that by, Mr. Letterman, what are we multiplying by?
0.7.
Yeah, 0.7. And then I'm going to divide by 1 minus 0.125 times 0.7. Okay, now here's what I'm going to do. I'm going to do this thing right here, and I'm going to put that in memory location number 1. So here we go. 0.125 times 7. I'm getting 0.875. Is that what you get? Okay, I'm going to store location 1. Then I'm going to say minus, open parentheses, 1 minus, and what do I do here? Recall 1. Close parentheses, equal. I am getting 0.75. That doesn't look right. I think you're right. So it's 0.125 times 7, 0.7. There we go. Whew. Well, I'm glad that that happened, so you know that I'm not perfect. Okay, store 1. Hell, you already knew, right? Divide by, open parentheses, 1 minus, recall 1, close parentheses, equal 9.59%. Is that the correct answer?
Yeah.
Excellent. Whew. Okay, so that was number 12. Yeah, go ahead.
Just for clarification, so I'm understanding it conceptually. So the clawback ratio, I mean, that's literally just like the percent of your net income that goes to retained earnings.
Yep.
Okay. All right.
Yep. And your net income can only flow to 2 places, dividends or addition to retained earnings.
Okay.
So those have to add together to be 1, right? Yeah, 100%.
Okay. Just one. Okay, we're good now.
Oh, I'm glad. Good question. Other questions? Okay. What is the firm's internal growth rate? What's the formula for internal growth rate? Like that?
Yeah.
Okay. Now, so we are looking for information that will lead us to ROA and the plowback ratio. The first thing it says is that they've got a profit margin of 7.5 and a total asset turnover of 1.5 times. Now, someone made a neat observation the last time we were here in class, and they said, wait a minute, if ROE is equal to ROA times the equity multiplier, and we know that it's also equal to profit margin times total asset turnover times the equity multiplier, does that mean that ROA is also profit margin times total asset turnover? And the answer is absolutely it is. And so we're going to find our ROA, profit margin times total asset turnover, is equal to profit margin of 7.5%. 0.075 multiplied by the total asset turnover, which they tell us is 1.5, And so when we do that math, 0.075 times 1.5 equal. Is that what you guys are getting? 0.1125. Okay, so we've got that number. Let's see what else they tell us. They tell us that they had net income of $550,000 and dividends paid to common shareholders of $100,000. The firm has no preferred stock. The reason they tell you that is if there was preferred stock, those dividends would have to be paid too, right? Okay, what can I calculate now that I know dividends and net income?
Retention ratio.
I can figure out the retention ratio, and I can go at it one of two ways. First of all, I could just figure out the dividend payout ratio, which would be 100 divided by 550. And then I would just subtract that from 1. Or I can say, wait a minute, if it's 550 in net income and I'm paying out 100,000 in dividends, how much are my retained earnings? Yeah, 450. And so I could say that B is equal to 450 divided by 550. You guys see that? There's two ways to get there. Do I care which way you go? Go ahead.
How did you get 450?
Okay, so there's 550 net income, and they're paying out 100 in dividends. And so what's left over? 450. Yep. Good question. Other questions? Okay, so 450 divided by 550. So here's what I'm going to do. I'm going to take, I've already got this number right here in my calculator. I'm going to multiply that by 450. And then I'm going to divide by 550. And that should give me exactly the same things as just multiplying by B. So all I did was take this number here, which is profit margin times total asset turnover. That's ROA. And then I multiplied it by B, which we said was 450 over 550. Now, if you wanted to, could you calculate B on its own, store it somewhere, recall it? Sure you can. It just takes longer. Okay. Now, should you be writing these things down like 3 decimal places on your paper and re-entering them in your calculator? No. You keep all the stuff in your calculator that you possibly can, which is what I've done so far. Okay, now here's what I want to do. This thing right here, what do you think I'm going to do with it?
Store it.
Yeah, store it in location 1. And so I'm going to say stow 1. What do I do next? Yeah, divide by, open parentheses, 1 minus, what do I do now?
Recall 1.
Yeah, recall 1, close, equals. I'm getting 10.14%.
Yes.
Cool. Other questions? Okay. This one is asking about the approximate year-end balance and accounts receivable for Wheat Corp. Wheat Corp ended the year 2023 with an average collection period of 60 days. What's another name for average collection period?
DSO.
Yeah, days sales and receivables, right? The firm's credit sales for 2013 were $12 million. What is the approximate year-end balance 2023 for accounts receivable for Wheat Corp? Okay, so we have the average collection period, which is also days sales and receivable. We know that is 365 divided by AR turns. Does that sound right? Okay, now, accounts receivable turns. Does anyone remember the formula? Sales divided by what? Ooh, close. Sales divided by accounts receivable. Now remember, when we're doing inventory turns, our sales number, we use cost of goods sold. But when we're doing AR turns, we use sales because of the apples to apples thing. These are both retail numbers. Okay, now, do you guys know that dividing by something is the same as multiplying by its inverse? Okay, so without doing any magic here, I'm just going to say 365, and I'm going to multiply by the inverse of this thing, which is accounts receivable over sales. Do you guys see how that works? Okay, now what are we actually trying to look for? We're looking for this accounts receivable number. And so what I'm going to do is I am going to multiply both. So I'm going to start with ACP, and I'm going to multiply both sides by sales. Does that make sense? It's on the bottom. I'm trying to get accounts receivable by itself. Do you see that? Okay, so I'm going to multiply both sides by sales. So sales is going to go away over here. Now, how do I get rid of this 365 from this side of the equation? Yeah, divide both sides by 365. And so when I do that, that leaves accounts receivable by itself. And that's what they're asking us to do. Okay, now I'm going to put in my accounts, my average collection period, also known as days sales and receivable. They tell us it's what, 20? Is that right? 60, very good, thank you. 60 multiplied by, what were the annual sales? 12 million. Divide by 365. $60 times 12 divide by 365. I'm getting 1.972600 million. Now, it makes sense when we think about this. If our stuff is out there outstanding for 60 days, then 60 divided by 365, that fraction of our annual sales should, on average, be in our accounts receivable. Makes a lot of sense. But this is the algebra to get there. Questions? By the way, I think I've told you before, the exam calculation practice, pretty much the same thing you're going to see on the exam. Now, if you are crummy at algebra, which most of you are, especially you Americans, what does that mean? Maybe go ahead and put this formula on your note sheet so you don't have to try to do algebra in the middle of battle. Does that make sense? Okay. Remind me, if we get done a little early, I will tell you how to battle test anxiety. I can tell right now some of you are going to have it. Okay, this is number 17. Oh. Okay, what is the value in year 3 of $1,000 cash flow made in year 6 when interest rates are 10%? when you see something like this, I want you to draw the time value of money line. And then we're going to say 1, 2, 3, 4, 5, 6. And so it's asking, so we've got this cash flow out here in year 6 of $1,000. And it's asking, what is the value of that thing in year 3? What do we call this number in time value of money talk?
Future value.
Future value. What's this one?
Present value.
Present value. So far, so good. Next question. How many time periods?
3 times.
3, because it's 6 minus 3. So our number of time periods is 3. And so we need to know one more piece of information, and that's the interest rate. And they tell us that the interest rates are 10%. I think we can use our TVM keys to do this. I'm going to hit clear, second, clear TVM. What do I put in for present value, or for future value? 1,000. Future value. What do I put in for I per Y? 10. And it's the whole number 10. 10 I per Y. What do I put in for N? 3. Very good. And what do I compute?
Present value.
Yeah, compute the present value. I'm getting $751.31, which is probably this one right here. Why is the sign negative?
Because we invest in present value.
Yeah, cash flows in opposite directions have opposite signs. Okay. The biggest one for people on this is figuring this bit out right here. That's the biggest. Oh, and the second biggest one is understanding that the cash flow happens in year 6. Sometimes they get screwed up.
Can we use a cash flow key for this problem?
You could, but it would be a lot more work.
Yeah.
Would you like to see it demonstrated?
If you don't mind.
Oh, you know me, I don't mind very well at all. That's what my wife says when, anyway, never mind. Okay, CF, second, clear work. Now, here's the problem. This is going to give us the time, the value at time 0. So we have to, we're going to be calculating the net present value at time 0, which means that basically what we're going to have are 2 cash flows of 0, and then 1 cash flow of 1,000. And so we're going to say CF0 is 0. We're going to arrow down. And then we're going to say C01 is 0. How many times does that 0 cash flow happen? 2. Enter. Arrow down. What am I going to put in for C02? No, man, we already, because remember we put in the F01 of 2? That covered this cash flow and this cash flow. So now we're on to the 1,000. Enter. NPV. What do I put in for I? 10. Arrow down. Compute. Lo and behold, the same number.
Yeah.
Did it take more effort? I mean, we could count key clicks. I'm pretty damn sure that was more, right? Plus, you had to have your brain in gear when you first started, knowing that this is going to be now times 0, right? Which would you do during the exam?
I would just like to know both methods just in case.
Ah, okay, I like that redundancy. Okay, so that was number 7. Which one was that? 17? Okay, so now we're on to 18. Oh, this one gets really hairy. So it's wanting to know the combined present value of all these cash flows, and these cash flows are janky, they're all over the place, so what are we going to use?
Cash flow.
Yeah, we're going to use cash flow. So it says you will receive a $750 cash flow in 2 years. a 1,000 cash flow in 3 years, and pay 300 in 5 years. Now, for me, I could do this without drawing a picture, but I would think you guys should draw a picture. So here we go. Here's time 0, and it says we're going to receive a 750 cash flow in 2 years. So we got 1, 2. So here, time 2, I'm going to have 750. And then they say a $1,000 cash flow in 3 years. And pay 300 in 5 years. Okay, so what do our cash flows look like? What is CF0? 0. What is C01? What is F0 or F01? It's 1, right? Because we have 1, 0 cash flow. C02, 750. What's F02? 1. There's only one of these cash flows. C03 and F03?
1.
C04.
0.
What's F04?
1.
1. C05
5.
minus 300, and what's F05?
1.
1. So let's put it in and see what we get. What's the first thing I do though? CF, second, clear work. CF0 is 0, C01 is 0, F01 is 1. Enter, arrow down. C02, 750. Enter, arrow down. F02 is 1. What's C03? 1,000. Enter, arrow down. What's F03?
0.
Try again. 1.
Oh, wait,
Oh, you were skipping ahead. Okay. Now let's see if Yarrow can get this one right. What's C04?
0.
0. Very good. Enter, arrow down. F04 is 1. And then C05 is how much?
Minus.
Yeah, 300 plus minus enter. Now, I'm really paranoid. I'm going to go back through these things and make sure those cash flows are actually there. And they are. What button do I hit next?
NPV.
Yeah, NPV. And what do I put in for I? 6. Enter. What do I do now? Arrow down. And then what? Compute. I'm getting $1,282.94. Is that correct?
Yeah.
Okay. Oh, this is a good one. How much would it be willing to lend the business owner when you borrow money? Are you borrowing the present value or the future value? Present value. So in order to find out how much these people would be willing to lend us, we need to find the present value of the cash flows at the agreed upon rate. And so they're saying that they can make $2,500 a month payments for the next 3 years, and then $1,500 a month for the 2 years after that. If the bank is charging customers 9% APR, how much would it be willing to lend the business owner? Now, what's the frequency on these payments? Are we doing these once a year?
Once a year.
Monthly. We're doing this monthly. And so that means all of our stuff needs to be in per month kind of thing, right? And so we're looking at $2,500 per month. We'll also need to be looking at our interest rate in terms of a monthly interest rate, but we'll get to that. Now, many students say, aha, I know what this is. This is just two annuities tacked together, and all I've got to do is find the present value of both of these annuities and then bring this one back in time, and you always get it wrong. Would you like to see the method for always getting it right? Yeah, okay, so here we go. CF, second, clear work. Customer states that he can repay a loan at $2,500 a month. By the way, when you borrow money, do you have to make an instant payment? No, it's at the end of the month, right? And so so CF0 is 0, but C01 is how much? 2,500. And I got to hit enter, and then I'm going to arrow down. What is F01? 36, yeah, how did you get that?
3 years times 12 months.
Yep, 3 years times 12 months, 36. Arrow down, what is C02? Yeah, 1,500. Enter, arrow down, what is F02? Yeah, 24, because it's 2 times 12. Okay, now what button should I hit next? NPV, and what should I put in for I? 9 divide by 12. Remember, it's an APR. 9 divide by 12 equals, enter. What do I do now? Arrow down, and then compute. $103,706.87. Questions? You can do it the other way, but I cannot guarantee your results. Oh, hey, there's nothing to erase. Okay.
Sorry, for this problem, so it's better to use cash flow instead of like a TVM, like present value, future value.
That's what I was just saying. Yeah. I'm telling you, you can do it that way, but you won't do it correctly. Yeah. And so here's the problem. If cash flows, let's say the cash flows start at time period 37 for that second one, what people don't realize is when you calculate a present value for that, it's one period back. And so they'll be trying to bring that thing back 37 time periods instead of 36, right? Because the present value you calculate for that is one period before. Oh, tricky stuff. Okay, the next one, payday loans. So they're asking for compound effective annual rate, and they're telling us payday loans are very short-term loans with very high interest rates. You can borrow $500 today and repay $600 in 2 weeks. What is the compound or effective annual rate implied by this 20% rate charged for only 2 weeks? First thing I want to tell you is that they've done you a tremendous favor here. They calculated that 2-week rate for you. They didn't have to. We could have said 600 minus 500 divide by 500, and that would give us the same 20% rate. Okay, now we know they're charging us 20% for 2 weeks. If I were to calculate an APR for that, what would I do? Say again?
I conversion,
Say one more time.
like using I conversion.
Oh, you're jumping ahead. I'm asking to find the APR. Oh, no.
Oh wait, it's 500 multiplied by 20.
Oh, she's getting there. 52 divided by 2 tells us the number of periods, right? And then in order to figure out the APR, all I've got to do is take that number of subperiods and multiply it by that 20%. So the 2 weeks rate is 20%. I'm going to multiply that by 26, and that's going to give us our APR. Now, why is that important? Because I can use this magical tool here. Second, the number 2, what does the number 2 say above it? Interest rate conversion. So I'm going to say 20, that's the 2-week rate, multiplied by 26, that's the number of 2-week periods in a year. That gives me 520. Then you've got to hit enter, or it's like it never even happened. Then we're going to, by the way, does 520% sound like a fair rate to you? No, it sounds crazy, right? Now we're going to arrow up, and it says C per Y. What does this mean?
Compounding.
Compounding's per year. And how many periods in the year? She's already told us. 26. Enter. Arrow up. This says effective, and it says 0. Does that mean the effective rate is 0? No, what do we have to do? Compute. And if you get frozen up on the exam, just look up here and it'll tell you. Okay, so we're looking at 11,347.55%. Oh my goodness. Yeah, that's huge. If you look at payday loans, they may not be that bad. Do you guys know about payday loans? You've probably seen these check cashing places. And you'll hear politicians say, well, loan sharks charge lower rate than that. And that's true. But what collection mechanisms do loan sharks have that the check cashing places don't? Leg breakers. They'll send someone to your house to break your legs so you'll pay, right? Does that make sense? Am I telling you to get in that business? Absolutely not. But you need to understand why they can charge lower rates, because the risk is lower. Risk and return have to go together. Okay, so that was 20. Now we're on to 21. After saving your entire career, you and your spouse are ready to retire with a nest egg of $800,000. Gentlemen, do you have a question? You got it?
Yeah.
Okay. A nest egg of $800,000. You need to invest this money in a mix of stocks and bonds that will allow you to earn $7,000 per month for 20 years. What APR do you need to earn? By the way, what do they plan to do after 20 years? No. They're going to retire, and then this is money needs to last 20 years. What do they plan to do in 20 years? Die. Okay, very good. So, first thing we're going to do is this $800,000 present value or future value?
Present value.
Present value. Second, clear TVM. I'm going to put $800,000 in as present value because it happens at the beginning of the retirement before the payments. And now we need to be able to get $7,000 per month. So I'm going to say $7,000, and I'm going to put negative because this is a cash flow in an opposite direction. I'm going to hit PMT. And this is monthly payments for 20 years. What do I put in for N? 240. And then what are we going to compute? I per Y. Compute I per Y. Is that the APR? No, we have to multiply by 12. And so the answer is 8.61%. You've got to earn 8.61%. Questions? Oh. Number 22. What annual percentage rate would you need to earn if you wanted a $400 a month contribution to grow to $32,668 in 5 years? In this case, what is $32,668? Yeah, it's future value. So I'm going to say second, clear TVM. I'm going to say 32,668 future value. And I'm going to put 400 in for payment, but what do I need to do first? Negative. Cash flow in opposite direction. 5 years of monthly payments. What's in? 60. And then what am I going to compute?
UI.
Compute I per Y. Is that my APR? No. What must I do? Multiply by 12. So I'm getting basically 12%. Questions? Okay, we've got one left to go and we've got time. Oh, this one always trips students up. This is the most American question on this whole exam. You'll hear these people trying to sell new cars and they say, you can have so much cash back, which is basically just a reduction in the initial price, Or you can have 0% APR or some other low interest rate, but you can't have both, right? And so what we need to do is examine both of these scenarios and figure out which is the better deal. They're asking for the monthly payment of each deal. So we're going to have two of them here. We're going to have cash back, and the other one is 3% APR. Okay. The present value situation for the cashback, the car costs $38,900, but you're getting $1,000 cash back. So what is the amount that you're borrowing?
37,000.
Yeah, $37,900. I'll make that negative. On the 3% APR, how much are you borrowing? 38,000. So minus 38,900. Okay, now they tell us that our both of these are 5-year loans. Car payments are monthly. Car payments are monthly, and it says what's the monthly payment. So we need to put in a number of months here. What do I put in for N? 60. That's just 5 times 12. Okay, then we need to put in our interest rate. Cash back. They said you can go out and borrow the money from your credit union at 7% APR. Do I just put 7 in here? Yeah, it's got to be 7 divided by 12. And for the 3% APR, it's just 3 divided by 12. And then we are going to compute the payment. So here we go. Second, clear TVM. I'm going to put in 60 for N. 7 divided by 12 equal for I over Y. And I'm going to put in 37,900 negative for present value. And then I will compute the payment. I'm getting $750.47. I could have put positive sign here, and then what would have happened here?
Minus.
Yep. That's it. Okay, now I'm going to do the other one. Now I've already got this 60 in here. I'm not going to bother redoing that because it's still there. In fact, I can prove it to you. Recall, and whew, there it is, right? Okay, so I'm going to say 38,900 negative present value 3 divided by 12 equal I per Y. And then I'm going to compute the payment. $698.98. Which one of these is a better deal? Would you rather spend $750 a month or $699 a month? Yeah, I'd rather do this, right? And those, by the way, are the numbers for the first choice there. Questions? Okay, I want to talk to you about exam anxiety. This class, for some reason, just gives people all sorts of anxiety. And I want you to keep a couple of things in mind. Number one, your entire life does not turn on this exam. Your entire life doesn't even turn on this class. So you've got to get that out of your head. This is something students often do. The second thing I will tell you is that before an exam, if you are anxious about it, you are full of nervous energy. So the best thing you can do is to figure out some way to get rid of that energy. Some people will go for a 3-mile run. My knees would not accept that sort of behavior. Other people may find other ways to reduce that level of energy or anxiety. So you need to think about what it is you can do to kind of calm yourself down. And then the third thing I would tell you, and this is the best one, and that is to be really prepared for the exam. So when you walk in there, you are confident and you don't have any reason to be nervous, and you're just going to walk in there and you're going to kick its ass. The other thing that goes along with that, being prepared, is making sure that you test all of your equipment beforehand, reboot your computer, reboot your router, your modem, whatever it is you've got, everything that you've got. Make sure that stuff all works well. Another thing I would tell you to do is, if possible, connect to your router or modem directly with an Ethernet cable. I have seen so many exams go straight to hell because someone's neighbor microwaved a burrito and screwed up their Wi-Fi. It happens, so don't do that. And finally, for the love of God, plug in your laptop before you start. Plug in your laptop and use the toilet. I've watched so many videos where I see people sitting there and their faces start to squint, and then they go, I've got to pee. And they take off and they come back. So I'm so sorry. Pee beforehand, right? Pee beforehand, plug in your laptop. Your life will be so much better. Questions?
Do we get 2 or 3 pieces of scratch paper?
2 pieces of scratch paper, 1 note sheet, handwritten both sides. Other questions? Okay, chapter 10 for Tuesday. Take your exam early. If you have problems, send me an email. Please reset my attempt.